Do you want to retire poor? If so, stop listening right now. Because on today's show, Dirk Leach shares real data on how poorly prepared most Americans are for retirement. The good news is that he's armed with a very simple, conservative game plan that changes that for all of us. You'll get all the details here. Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Invest in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together, we're going to make the best investments that we can, so thank you so much for joining us. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investinthefamily.com and subscribe to the podcast at iTunes or the Google Play Store. And if you would like detailed show notes from today's episode, simply text the one word, family notes to the number 44222 or sign up for the email list at investinthefamily.com. If you're looking for an online stockbroker, then you may want to consider TradeKing. TradeKing has been 4-star rated by Barron's for 10 years running. They have some of the most competitive pricing in the industry with trades for less than $5 and great customer service if you ever have any questions. You can also get a bonus for signing up as an Invest in Family listener if you go through my link at investinthefamily.com/TradeKing. That's investinthefamily.com/TradeKing. Sign up for one of my favorite online brokers, and we can both get a bonus for doing so at investinthefamily.com/TradeKing. And I hope you enjoyed today's show with Dirk Leach. Well, hey, Dirk, welcome to the show.
Thank you. I enjoy the invitation.
Well, I appreciate you giving us a little bit of your time this afternoon because I know your time is valuable. And you wrote an article recently called The Best Investment of Your Lifetime That You Can Make Today. And first of all, as someone who creates a lot of content, I want to applaud you for a great content title. And I think it got a lot of attention for that. And it definitely got my attention as well. And I would love it. Do you mind sharing with our listeners the thesis behind that article and the big point you're looking to make there?
Sure. It's really pretty simple. I spend a lot of time, I mentioned earlier that I'm retired, and so I spend a lot of time what I call self-educating. And I had run across an article quite recently that expressed the lack of retirement savings by various age groups. And in particular, the 18 to 29 group, roughly 50% of them have no, and that's zero, retirement savings. And frankly, that's amazing and a little bit scary. It's particularly scary given the demise of the defined benefit plan that used to be in vogue. Roughly 30 years ago, companies started trimming that. And today,
and by defined benefit, you mean like a pension, for example?
Like a regular pension, exactly. Like a company-provided pension plan. It used to be that most companies offered that as one of the benefits. And today, roughly 30 years later from when they started trimming back that benefit, almost, I think it's down to roughly 10% of private companies offer a defined benefit retirement plan. And so the responsibility for your or our retirement savings has clearly been shifted from the employer to the employee. But people have not really responded appropriately to that shift. And as I said, roughly 50% of 18 to 29-year-olds have zero retirement savings. And even people in their 45 to 59-year-old range, only 23% of them have 23% of them have no retirement savings. So that kind of got me interested in, why folks are effectively not responding to that shift in responsibility for retirement planning. And I, wrote this article. So I have to also say that this article was clearly the most popular article I have ever written.
Congratulations.
It is now pushing 60,000 page views, and for me, that's a lot.
That's a lot. That's a lot. Period. I talked to a lot of people, and that's a lot of page views.
Yeah, that's what I thought. I've never had anything come close to that. The nearest competitor is down in the 20,000 range. So, it filled a niche that was needed. Anyway, so that was the thesis. The thesis is that, retirements 20 years from now are going to look a lot different than they do today, because they're going to be preferentially or almost all funded by people's own funding. In other words, employees' own funding, and not by companies. Social Security isn't really going to provide a very comfortable retirement. It doesn't today. And if you look at what's happening with Social Security, the trust fund IOUs, and everybody should understand that the Social Security system is now drawing down some of those IOUs that the federal government put into the trust fund when they were taking the excess contributions out. And
so
those
is
are now...
is that kind of the equivalent of Social Security drawing on their principal, essentially?
Well, I guess the way maybe I'll rephrase it like this. Social Security ran a surplus for quite a while because there were 3 or 4 workers for every retired person. And that surplus, instead of being put into some, quote, real trust fund where the money actually resided, it went back into the Treasury, into the general fund, and was used for everything that the government spends money on. And in the actual Social Security trust fund, the Treasury put, quote, IOUs. Okay, so we owe you money in the future. So the money isn't really there. There's just IOUs. And today, we're actually starting to draw down those IOUs. And money that the Social Security surplus provided to the General Treasury is now being pulled back. About 2035, those IOUs will run out. The surplus from previous years will be used up, and the existing payments into the Social Security system will be insufficient to provide for the current retirees in 2035. Roughly 70% of the retirees in 2035 will be covered by current Social Security tax revenues. So the government is going to have to do something between now and then. And that something can be trimming back Social Security benefits, raising the Social Security taxes, either the actual tax rate or the cap on earnings that are taxed. But something has to change between now and 2035 in order for retirees 2035 going forward to even be able to get the payments they've been promised. And so my way of looking at this is, if you're banking on Social Security after 2035 as your only form of retirement funding, you're probably not going to have a very comfortable retirement. And so it's really important that folks who are going to be retiring 20 years from now, so that's the next generation behind us, or at least behind me, really needs to start saving for their own retirement. And that's really the point that I'm trying to make in this article, is that folks who are working, most companies, around 65% of companies, provide some form of 401k plan. Most of them contribute a portion of the employee's contribution. Some don't, but most do. And it is obviously, when you work out the numbers, it is obvious that it is the best investment that an employee can make today in utilizing that 401k plan, if only for the tax-deferred growth that they're going to get over the next 20 or 30 years. If the company also provides some benefit, in other words, some contribution to that plan, some portion of the employee's contribution, it's even better. And that's shown in the table, one of the tables that's in the article that I wrote. It's frankly not too hard to accumulate over a 30-year time frame roughly $1 million for retirement. And that'll go a long way to making it more comfortable.
Sure. So to get to that $1 million mark over 30 years, what like annual contribution levels and returns were you assuming? Do you remember?
Yes. Well, I pulled up the article. I've got it in front of me to remind me. I think that the after-tax return was 7%.
Okay.
And, excuse me, not after-tax return, after-inflation return was 7%. And that we were talking about, I think, let me find it here, $4,800 a year. And roughly, I chose that number because it was a nice round number. It's $400 a month. And it's well under, if a 401k plan isn't available, the other alternative is an IRA.
Right.
And that's well under the IRA cap for contributions. And so with that kind of return and that kind of monthly deposit, you can accumulate, depending on whether your company contributes or not. If your company contributes roughly half of that, you could accumulate $1.4 million. And if there's no company contribution, you can still accumulate close to $1 million, $960,000.
Wow. And so if you say inflation annual return of 7% after inflation, so I guess that means obviously the variations for inflation would change from year to year, but I guess that means like a real return or an actual return of probably 9% at this point. So you need to be getting around 9% in the markets most likely over that period of time to be able to do that, which is high, but can be done, of course.
It indeed, it can be. Actually, I misspoke on that. I assumed 7% before inflation, 5% after inflation.
Oh, okay. That helps a lot.
So that helps a lot. And I think that's eminently doable. We'll say eminently doable.
7%. Yeah. 7% is definitely reasonable. I mean, which, it's funny. Years ago, people would like cry if they heard they're only getting 7% annual return. But right now that sounds pretty nice.
Well, you used to be able to get 5-6% on a bank CD.
Yeah, okay? Exactly.
I think those days are probably long gone, or at least we won't see them for quite a while.
But someone could invest conservatively and get most likely someone can invest fairly conservatively and probably get 6 to 7% with a fairly reasonable expectation, probably.
Yes. And I think that the history of the market has proven that, it has varied from around 9 to 10% if you look over very long time frames. Mm-hmm. And I don't think that the fundamentals have changed significantly such that, we're going to see the next 30 years of people only getting a couple percent return. I know there are a few analysts in that camp. I'm not one of the people that believe that. I believe that we'll continue to be as productive roughly as we have been for the last 50 or 100 years. So I'm looking for those kinds of returns, and as I said, I think they're eminently doable.
Wonderful. What about when it comes to 401k? Obviously, this has been a very popular direction for a lot of people that have the option to invest in a 401k. Usually, that's just the most obvious thing is put your money in a 401k or have an automatic distribution every month where some of your salary goes into the 401k, so you never see it, that type of thing. That seems to be a pretty popular option for people who are wanting to save for retirement. It does seem like more and more I'm reading and hearing things that seem to be undermining the actual benefits of the 401k once you factor in fees, management fees, and other fees that, may not be so obvious to the investor. Is that something that you've looked into very much that may affect your opinion, or do you think that most of that is not of significant concern?
Well, I have to say that I have looked into it a little, not enough to speak on it authoritatively. It is clear that obviously there are some instances, maybe they're outliers, maybe they're more prevalent than I know, but there are definitely some cases where companies have not done the best job in selecting the company to manage the 401k or to structure it such that the employees have a solid, diverse group of funds to choose from. And occasionally I've read that some companies will preferentially or maybe only offer the company's stock as one of the options or the option for 401k investments. And, frankly, that's a poor plan. For employees who are in that situation, they really ought to be going to their human resources department and saying, hey, we've got to have a better option here for our 401k savings. Because, it is the company's responsibility to set that up, and they really should be doing right by the employee and giving the employee the diversity and some broad selection of funds to choose from, and ones that, frankly, don't have exorbitant fees that are being charged to manage those funds. But I don't think that obviates the benefit of 401ks in general. I think it's an issue that probably needs to be addressed, but the 401k is still a really good option.
Well, and I think one of the things too that makes it potentially a really good option for people is the fact that it can be automated, and so even if there are fees that are a problem, even if the returns aren't as high as you may want them to be, the fact that it's quote unquote forcing you to do it may be one of the best features of it, because at least something is happening. Whereas if you're left doing it yourself, some of us are disciplined enough to quote unquote pay yourself first and put that money aside. But based upon savings rates and spending habits and debt levels, that communicates that the vast majority of us are not doing a very good job of being disciplined in that sense. So 401k can definitely help on that side, which is nice.
Yeah, that's very true. It's really a lot easier not to spend what you don't have in your pocket.
Right.
So if it goes automatically to your investment account, your 401k account, that makes it a lot easier to have a regular, periodic, continuous savings rate. And that's really important.
And in the article, you mentioned some different, obviously every company is going to have different options, like you mentioned, as far as where you can put that money in your 401k, what funds you can invest in. But you mentioned some different funds that you like. Do you mind sharing a little bit about some of those now?
Yeah, not at all. I have a preference for Vanguard investments. I've been with Vanguard I just counted it up, 34 years. So I know the company pretty well. It's not I wouldn't call it one of the high-flying fund companies. They're a little more stodgy, a little more conservative, but that fits me pretty well. And so I like Vanguard funds. And in particular, I highlighted the Vanguard Dividend Growth Fund, which I have to admit is closed to new investors at this point. Huh. Vanguard does that periodically when the fund manager really just can't find sufficient alternatives for investments that meet his criteria for the fund. And so periodically...
Which I highly respect. I mean, it's unfortunate that it's not available to new investors, but I really respect the fact that the management is that disciplined to not take new money. That's a pretty big deal because they can't use it well.
It is. And that, I think, speaks to Vanguard's conservative nature. They're not going to waste your time and money by collecting money and investing it inappropriately, or sticking it in leaving it in cash, which effectively gives you a little return. Mm-hmm. So the Dividend Growth Fund will reopen. Vanguard funds, have done this over the years. I've seen several of them close and reopen. Another one that I chose is Vanguard Healthcare Fund, and I think almost, I shouldn't say any, but a lot of healthcare funds would fill the same bill. With the baby boom generation retiring, and there are an awful lot of us, we're all getting older, we're all retiring, and we're going to use a lot of healthcare. On top of that, we've got the contribution from the ACA, the Affordable Care Act, that also gave people an option to have health care that they didn't have previously. And that may not be working out as well as it was sold to us by the Obama administration, but nonetheless, it is a driver. The healthcare fund, I think, is going to be a good fund for many years as the wave of baby boomers kind of move through the economy. The other one that one of the others I highlighted was the Vanguard Energy Fund. I have used this technique years ago, where I think that there's a large, what I call a macro trend that is going to affect the economy. And I think the energy fund is one of those macro trends that we're going to see. Crude oil fell so far for so long in price that we are actually not investing in enough new reserves and production to provide for any significant growth in the future. And so if there's any recovery in the global economies, in, say, China, China is still growing at 6%. India likewise is still growing at 6 to 8%. But if there's significant recovery in global economies, and the demand for crude oil actually goes up from its roughly 1% per year, 1 to 1.4% per year, we're actually probably going to see a crude shortage, because we have not invested in the ability to produce additional crude to make up for either demand or the decline rates that affect effectively all oil fields. So, it's a long-term investment. It's one, I think, for the next 10 to 20 years. But I think an investment in basic energy would be a very good investment for the next couple of decades. I also highlighted the Vanguard Windsor Fund, actually Windsor 2, and also the Vanguard Global Equity Fund. Globally, I think that if I looked at the U.S. and compared it with the rest of the countries around the globe, we're probably I would say the best of a sorry lot at this point. U.S. economic growth isn't exactly robust today. We're looking at maybe 1.8% GDP growth this year. And the rest of the globe is not much better, and in a lot of cases worse. And so I think it's a good time to put some money into global or non-U.S. equities from a contrarian standpoint. I do believe that the global economies will recover, and so I think that investors want to have some small portion of their funds in stocks outside of the U.S. So that's why I included the Global Equity Fund. Now, all of those are Vanguard funds, but I have to say other companies like Fidelity, Franklin Templeton, T. Rowe Price, and others have equally equivalent funds. And so, I made the pitch for Vanguard, but other companies have funds that would fit the bill just as well, and in probably some cases better. So
well, and what you... sorry.
Yeah, the important thing is not the Vanguard funds. The important thing is identify a good fund, use your 401k to invest in that fund, do it early, and do it for a long time, and you'll have a comfortable retirement. That's the point. Wonderful.
Well, and I think you've presented that really well here, Dirk, and I appreciate it, because so many people, one of the reasons I have this business and this podcast is to help people learn to invest, and there are all kinds of different personalities and temperaments and circumstances that people are facing out there. And some people like diving in and learning about investing, and some people are really intimidated by it. But even someone who may be intimidated by investing and not know what to do, you've presented a very, very basic and pretty realistic approach for people to take, and that could make a big difference over time. It's so easy to think, man, 7% a year, only $4,800 a year. It doesn't sound like much, but I don't know anyone that does a good job of realizing the power of that compounding over time. Because the fact that you could put that amount of money away, a little under $5,000 a year, making 7% a year, and before inflation, including inflation, that's pretty remarkable. That could get that to $1 million in 30 years. So that's hopefully it gives a lot of people hope listening to this and knowing that is feasible, and that could make a tremendous difference for a lot of people's lives. And so we appreciate you writing the article and appreciate you coming on the show today and sharing it with us here as well.
I appreciate the opportunity, and I hope folks do get some benefit out of the article and the concept of compound interest, which really is almost magic.
Wonderful. Thank you so much, Dirk.
Thank you.
We hope you enjoyed today's interview with Dirk Leach. Remember, you can get full show notes with links and other details at investorinthefamily.com. And don't forget to subscribe to the show at iTunes, Stitcher, or the Google Play Store. And if you want the summary sheet notes from today, simply text the one word, family notes, to the number 44222, or visit investorinthefamily.com and sign up there. We'll make sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.